Hello, and welcome to the Stockout. Mike Baudendistel here from FreightWaves, analyst, market expert, follow the CPG industry and also the intermodal industry here at FreightWaves. And this is the Stockout, a show that we set aside 26 minutes to talk about what's happening in the world of CPG supply chains, and various transportation issues as they relate to CPG. So, wanted to have a show that really addresses that important shipper group. And today on the Stockout, have a lot to talk about. There's been a lot of news in the CPG industry over the last week. I'll talk about the biggest thing, which was the Kellogg announcement that Kellogg is going to split into three companies at some point by the end of the next year and a half, by the end of 2023. So I'll give some thoughts on that. I actually really liked the announcement. Also had an announcement that Mondelez, in a blockbuster acquisition, is going to acquire Clif Bar in a $2.9 billion deal. I'll talk about that. And we have a story up on freightwaves.com about Kraft Heinz changing logistics suppliers, which I'll talk about why that's important. And then, rail congestion has really been sort of the topic of the hour, lack of rail congestion. So I'll discuss that and what that means for CPGs. And if there's time, I'll talk about the Biden administration's proposal to mandate lower nicotine cigarettes, which I think also are included in the CPG industry as well and under that category. So a lot to talk about today, and I'll just sort of get right into it with topic number one, which I think was the biggest topic over the last week, which is Kellogg is going to split into three companies. We don't know what those companies are going to be called, but let's call them Snack Co., North American Cereal Co., and Plant Co. to start with. And Kellogg's been an interesting, company. I mean, it's really performed well over the last, year to date. I mean, actually, shares are up 9% year to date versus a decline in the S&P of 18%. So there's really been this flight to quality, which has been, representative. There you see a stock chart, and you see Kellogg shares are in black, and the S&P 500 is in blue. And so a lot of CPG companies have really outperformed the market so far this year. That's really been sort of sector rotation, a flight to quality. I think a lot of investors in CPG have felt left out the past several years as the higher risk, higher reward names have outperformed. And this is sort of revenge of the boring stocks, revenge of the consumer staples is what we had, this year. And that sort of takes us to last week's announcement, with Kellogg. And it really became clear that snacking is where the value is, for Kellogg and the rest of the CPG space. The current CEO, and it sounds like management team, is going to focus on running and is going to just only run the snack portion of the business and the international portions of the business, and the cereal, North American cereal, is going to get spun out, and Plant is going to get spun out. You see this graphic, and that's really where the revenue was in global snacking and international. That's going to be about 81% of the business in terms of EBITDA. Cash flow about 87%. And part of the reason why they're doing this now is, over the last year, there's really been a lot of distractions with some of the other segments, and really what investors should be focused on are the snacking business, which is growing high single digits. I think they have the potential to grow high single digits. These would be snacks that include Pringles, Pop-Tarts, Cheez-Its, Rice Krispies, Nutri-Grain bars, RX bars, et cetera. That's under the Kellogg umbrella. So a lot of valuable brands there. And the idea is that not only have Americans taken to snacking during the pandemic, snacking a lot as things open up and you need food to go, and that behavior has stuck. But also there's this transition where they can leverage a brand that's strong in North America and move it to international markets, and it's a way for people in other countries to buy a little piece of America. And you sort of see that with the Pringles brand, which is one brand that company acquired several years ago, and so this is a Pringles can from Taiwan, and so these are beef curry flavored Pringles, and so Pringles is really an international brand, but in the portfolio that Kellogg's has, it's kind of the outlier. When you think about some of their other snacking brands, they really don't have that presence, and it's a lot of untapped opportunity. And so that's part of the reason why this company's splitting up is if you're an investor and you're interested in a growth at reasonable price, sort of in a GARP portfolio that has some, you're mandated for revenue growth. The snacking portion of the business is going to give you that revenue growth. When you look at the other portions of the business, the North American cereal business, that's something that's maybe more appropriate for an income investor. Would expect the dividend yield of that to be at least 3%, maybe even 4%, given where Kellogg's current dividend yield is 3.3%. And part of the idea is that the snacking business is going to be valued more highly by Wall Street if it was a standalone business. And you sort of look at what how shares of Kellogg are trading, and they're trading about 17 times forward earnings, which is about close to in line with General Mills. And so it's almost like it's getting a cereal multiple, whereas because snacking, like I showed a minute ago, is most of the revenue, most of the cash flow, really deserves a multiple that's more in line with a best-in-class snacking peer, which would likely be Mondelez, which owns Oreo, and as of just was announced, they're going to be acquiring a Clif Bar. And sort of as we get to sort of why are they doing this now is really in the last year, the value of the snacking has been, maybe obscured by some of the other events that have taken place in some of the other, businesses. Sort of in the last year, the cereal business has had to undergo strikes. You see all those, workers that do the Frosted Flakes and those things that you've had to shut down plants. They've had to import cereal from overseas. And there was a fire that closed the facility. And so the cereals come under a lot of pressure. And then the plant portion of the business has really been one that's simply been kind of a speculative portion of that business. Now, it's only 2.5% of sales. Still, I think it can be kind of a little bit of an overhang when there are just so many negative headlines about plant-based foods and plant-based alternatives, which was the case over the past year. I mean, really the main way for investors to play plant-based is in shares of a company called Beyond Meat, which is down a whopping 84% in the past 12 months. And so by carving those things out, you have three different types of investment vehicles for three different types of investors. Plant-based would be more for a speculative investor, this North American cereal company, or maybe before an income portfolio, something that's stable. And then the one where investors are chasing growth would be in the snacking. And makes you wonder, are other companies going to follow suit? And we have seen a lot of acquisitions and divestitures in the CPG industry. You've seen a lot of companies like Nestle build out their portfolio of healthy brands, of their portfolio of things like vitamins, things like pet food, healthier pet food. One where you might see a similar split actually is Unilever, which has already announced that they're going to be reorganizing from 3 segments to 5 segments. They have an activist in there. They've underperformed Procter and Gamble. And it does make you wonder if Unilever is going to spin off the ice cream business, which has been a distraction given Ben and Jerry's tweets, which has caused some state pension funds to think about, if not entirely remove Unilever from their portfolio. So that's been kind of a headache, and so that's one just sort of speculation on my part where you might see a similar split up. So why should transportation companies care about this or logistics companies care about this? I mean, clearly, if you're in the CPG industry, I think snacking is kind of where you want to be if you want to be in a business that's growing. And I think that some of the other segments are still stable. And so far, some of these big CPG companies really haven't seen much consumer retrenchment. And heard from various logistics companies that say when they're really sort of directing carriers to focus in on CPG as a just sort of an avenue to have more stable volume. Topic number 2 here is Mondelez announced acquisition about a week ago of Clif Bar. And this highlights some industry trends. So this is really also shows the value of snacking. So this was a $2.9 billion deal on Clif Bar's $800 million in revenue. So that's 3.6 times revenue. So a lot of value there. And that does not include additional consideration for an earnout based on meeting certain undisclosed targets. So, huge day for Clif's, current owners, the founders. And this is what Mondelez is traditionally sort of known for. Is you think of Mondelez, you think of Oreos, maybe not Oreos that are broken like in that picture, but things like various maybe unhealthy snack foods, confectionery items, Cadbury cream eggs, Toblerone, chocolates. Those type of things are Mondelez's sort of things they're most known for. But since 2018, Mondelez has done 9 acquisitions. 5 out of those 9, including Clif Bar, have been in the healthy segment or those related to living in a healthy lifestyle. And that, I think, is a major trend in the CPG. Is a lot of the companies have tried to shift their portfolio in that direction. If brands are not growing, like a lot of confectionery brands, aren't. A lot of those are divested if there's not a way for them to grow, internationally or in other markets. So I think that trend is going to continue. Nestle has really probably been the one that stands out to me as having done really well, with that strategy. There were also some interesting comments that Mondelez made publicly about the market and just the CPG market. They were at a Bernstein conference, so another Wall Street group. And they, the CEO, Kirk Vanderput, was there. He talked about, a couple of things that Mondelez monitors that I thought were interesting. So they monitor sort of what percentage of households are buying, specific brands. And then they're also monitoring how much of a quantity that those specific households are buying. So it's actually a pretty sophisticated, system of looking at, how much consumers are buying at any one point in time. And so they can actually see if a lot of consumers, who usually buy, households that usually buy, 2 packs of Oreos are going to buy 1, or maybe they're buying a smaller pack instead of a larger pack. That's the type of thing they're looking at. And so far, they haven't seen the consumers really retrench. And the CEO said it's, quote, been kind of weird that you really haven't seen that yet, given what's happening with inflation. One nuance there with Mondelez is that they're about 90% hedged on cost, which is a lot better than most other CPGs. And so their price increases have been, more moderate than some of the others. And so with CPG, a lot of times, the prices increase 4 or 5%. Consumers don't really change their behavior. But if they raise them 9, 10%, that's where you see consumers start to pull back. And Mondelez also said that their cost increases next year are going to be just as much, maybe even more than they were this year. And so that's something to watch out for. And it just shows, I think that's true of a lot of CPG companies where they're going to continue to raise prices throughout this year into next. It's hard to see how inflation is going to abate, at least in food, in the near term. So I'll move on. Big deal from Mondelez with acquiring Clif Bar. Topic number 3. This was on website freightwaves.com. DB Schenker announces layoffs in Texas near Fort Worth after losing a contract with Kraft Heinz. So as reported by FreightWaves' Noy Mahoney, logistics company DB Schenker is laying off 130 employees from Kraft Heinz distribution center near Fort Worth, according to a notice sent to state officials on Tuesday. And so Kraft will not be closing this distribution center. It will remain open. There's about 200 workers that will remain employed there. And it's just a function of Kraft Heinz deciding to use DHL for its logistics needs rather than DB Schenker. I don't know whether that was price related or service related. I could only speculate from where I'm sitting. But basically, I think it does show the importance of keeping the big CPG companies happy, and just sort of what can happen when CPG companies go another way. I mean, it could lead to companies having to cut if they're in a certain location. So, CPG companies are really sort of the ones right now that are being coveted by carriers, by logistics companies. I mean, their volumes, if they're down, they might be, but they're going to hold up better than a lot of other goods. And when we look at the transportation market overall, inventories at the retailer levels are high in general. We all saw what that Walmart's inventories are about 35% higher than they were a year ago. Target's about 45% higher than they were a year ago. The nuance there is that's really for general merchandise. It doesn't pertain to food or consumable products. Those are much more, sort of in line. So really, if you see retailers cut prices, it's really going to be more for goods that consumers don't actually really need, sort of more wants rather than needs. Topic number 4 is rail service is deteriorating. I think, there's been a lot talked about in the last, really in the last week, but just even today, sort of just seemed like a lot came across my desk on rail service. And I have a chart that I think is interesting from Sonar. So this is the intermodal outbound tender rejection index from LA. So this is containerized intermodal volume. And normally you sort of would have what you see in the middle part of that chart in late 2018 and 2019, when the transportation market wasn't particularly strong. You see that intermodal tenders don't get rejected very often. They're down there 1%, maybe less than 1%. And you saw with all the supply chain issue, transportation congestion, late 2020 and last year, that tick up to over 10% in a lot of cases, which is really sort of something is not going right in the transportation industry when that happens. Earlier this year, it had been down at that 1% range, and sort of that March through May timeframe. I'm on the right side of that chart for those watching the video. But then lately here in June, it spiked up to about 5%. You see it there at 4.9, and so that is an indication something is not going right with service. And some of the things that we've said from around the industry, about 29,000 boxes are being held in container yards. That's per Gene Soroka, a Port of LA's executive director. We see him a lot on FreightWaves TV. We're seeing chassis being used as makeshift storage again. That's not good, because we know how bad the chassis shortage was last year, and so that seems to be coming up again. And so these things are happening, even though the number of ships at anchor outside the ports of LA Long Beach are the lowest it's been in 2 years. They're down to about 20 versus a high of about 100. And so I think that's a function of maybe some companies moving goods through other ports, but I think a lot of it is just retailers ordering less because they recognize that their inventories are at a high level. Our data shows that's expected to continue, and I think in the coming weeks you'll see that there aren't any container ships waiting outside of the ports of LA Long Beach, and that may be the ultimate thing that alleviates this rail congestion that I've been describing. But clearly right now there's lots of congestion in and around the Chicago area as well, which is typically the most congested point in the freight rail system. Things like containers piling up, storing containers on chassis, not having enough chassis, all of those things that were big problems in the summer of last year and the third quarter of last year, starting to rear their head again. But ultimately, lower freight volumes might be the thing that solves it this year that wasn't able to solve it last year. So I'll move on to the last topic, which is one that have written a little bit about, but is will cigarettes become nicotine light? And so there's been a lot of discussion of ways to make cigarettes less harmful and to discourage children from using nicotine. I mean, there was this the FDA has banned Juul's e-cigarettes, which I think might have a long fight in the courts to see if the courts will actually uphold that ban. That came after it was the company Juul was not allowed to have flavored e-cigarettes because supposedly flavors appeal to a younger crowd that would be underage. But now seems like there's this whole new fight where the Biden administration is developing a proposed rule to establish a maximum nicotine level for traditional to combustible tobacco products. And so that's kind of interesting. It's not clear, if this would actually be feasible, if you could just take the nicotine out of it. It would sort of make it, going back on the long, quote that the cigarette is just a nicotine delivery system. It's, nothing more than that from all those tobacco hearings. But not clear whether it'd be feasible. Not clear whether this would give rise to a robust black market of cigarettes that are imported from other countries that are not approved for use in the United States. It's not clear whether this would just force existing adult smokers that are law-abiding into withdrawal at one time and would make for a lot of, I think, grumpy people as they try to get off nicotine at once and sort of experience withdrawal. I mean, certainly it would reduce the cravings and addiction factor. And I think one of the statistics they cited is that more than half of adult smokers get addicted to the nicotine before they become old enough to actually legally purchase cigarettes. So there seems to be something that the Biden administration is going to at least push for. The next step is that the FDA would issue a notice of proposed rulemaking by May 2023, which seems likely, and there would be a time for public comment, which, I've seen that happen in transportation industry where there's some notice of proposed rulemaking, regarding some change to a trucking hours of service rule. And then you get all these, complaints from people who that would negatively affect. And it gets sort of to be a kind of a complaint session in Washington, D.C. Think that would be the case here too, perhaps with the tobacco industry sort of leading the charge. And I think any ruling, which is probably not likely until, 2024, maybe end of 2023, would be challenged in the courts, tooth and nail. One thing that was interesting is there was one, research report, I was reading, it was written by Stiefel, one of my former colleagues there, who said that this is a potential negative for Altria because it relies heavily on the combustible products, but could actually be a positive for Philip Morris because their portfolio is weighted towards the non-combustible cigarettes or sort of less harmful products. And that seems to be, their big push. So sort of, believe it or not, Philip Morris is trying to position itself as an ESG name because under the argument that their products are, at least the ones that fall under the Philip Morris, corporate umbrella rather than Altria are designed to be less harmful and help people reduce, cigarette usage and have less harm, with those cigarettes. So kind of an interesting, development, there, which I don't, talk a lot about that sort of subsector, but I think that falls under CPG and consumer staple. And, another one that is relatively stable when, consumers are looking to cut back, sort of put that in the same category as coffee, where people sort of will buy, that category of product, no matter if prices are rising or not. They'll cut back on something else first. So that's really what I wanted to go over today. And if you're not signed up for it already and this type of content is helpful to you, I would encourage you to go on up to freightwaves.com and go up to newsletters at the top. And you can just go right at the top under supply chains to the Stockout, which is this CPG newsletter. Try to get it out twice a week, every Wednesday and Friday, like it did last week. There are times where it only goes out once if we're inundated with, requests from, Sonar customers and working through Sonar data issues and those type of things. But, we want to keep everyone updated on the CPG industry. It's an important, shipper group and not one that's going to go away, anytime soon. And would also encourage you to sign up for the other newsletters. One that's really related to this is this new one, Running on Ice, that Sydney Edwards puts out. I think there's a lot of overlap between those people that are interested in CPG and those people that are interested in cold chain, because a lot of CPG will have to move refrigerated as well. And then there's a lot of overlap too with the point of sale newsletter, which I think the relationship between the CPGs and the retailers has gotten to be a little bit more contentious here lately, because the CPGs have tried to ram through price increases and really justify it in a lot of cases. I mean, you've seen the CPG margins contract, so it's not like their costs haven't risen by just as much. But the retailers, they are pushing back. They are actually auditing what the price increases that the CPG companies are demanding, and making sure that the rise in inputs really is as severe as the CPG companies say it is, in order to justify those price increases. So a lot going on there, and the CPG industry. I think the CPG industry is as strong as their demand has been during the pandemic. It also gives rise to a lot of these other types of issues. for the newsletters coming out later this week, I'm going to try to dig into what's happening with fertilizer prices. Those have been volatile. Dig into that. Dig into any commodities that are also important for the CPG industry. But I encourage everyone to continue to go up to freightwaves.com, look at all the great content there. And that's really all I had today. But hope everyone has a great week.